Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. Today, we're diving into a fascinating mix of stories that really capture the pulse of the financial world right now. We've got some surprising trends in housing, a bold move from an electric vehicle giant, and of course, the ever-unpredictable world of cryptocurrency. Okay, let's unpack this.
What's interesting here is that these stories, while seemingly separate, are all connected by a thread of uncertainty and shifting sentiment in the markets. From housing to tech to crypto, investors are reacting to concerns about inflation, potential trade policy changes, and the overall economic outlook. It's a fascinating moment in time.
It definitely feels like we're at a crossroads, and the Wall Street Journal's piece on the housing market really highlights that. Who would have thought we'd see some regions bracing for a potential dip in home values, while others are still struggling to find enough houses to meet demand?
It's a real tale of two markets, driven by a unique combination of factors. The article highlights how places like Texas and Florida, which were booming during the pandemic, are now showing signs of oversupply. Texas has 20% more homes for sale than before the pandemic, and Florida's housing stock has grown by 15% since 2020. But at the same time, demand is cooling as mortgage rates remain high. That combination could spell trouble for homeowners in those areas.
So you've got this potential oversupply in some regions, and then you have the Northeast and Midwest, where inventory is still incredibly tight. The journal points to factors like strict zoning laws and high building costs. In states like Illinois, it's a real puzzle for anyone looking to buy or sell right now.
Exactly. And it makes you wonder, if you're a homeowner in, say, Florida, what's the play? Do you ride it out and hope prices rebound? Or do you consider selling before a potential dip? On the flip side, if you're a buyer in the Northeast, do you wait for more inventory? Or does the fear of missing out push you into a bidding war? It's a fascinating dilemma playing out across the country.
It definitely puts the whole location, location, location mantra into perspective. Now shifting gears to the electric vehicle market. Bloomberg reports that BYD, a Chinese EV manufacturer, is looking to raise a massive $5.2 billion through a share placement.
This is a bold move by BYD, especially in the current economic climate. What's striking is that the offering price is at a discount to their current share price. This suggests that investors see this as a buying opportunity, potentially betting on BYD's long-term growth and its ability to compete on a global scale.
It's a huge bet on the future of electric vehicles. But it also raises questions about the competitive landscape. The EV market is becoming increasingly crowded, with both established automakers and new players vying for market share. Do you think this move by BYD puts pressure on the competition to step up their game?
Absolutely. We're talking about one of the largest capital raises ever seen in the EV space. This influx of cash will allow BYD to invest heavily in research and development, expand its manufacturing capabilities, and potentially even accelerate its international expansion plans. This could shake things up for other EV companies, including those here in the U.S.
Speaking of U.S. companies feeling the pressure, let's turn our attention to big tech. Bloomberg has a couple of articles that highlight the challenges facing the so-called Magnificent Seven tech giants. Despite strong recent earnings, their stock prices have taken a hit and entered correction territory. What's driving this shift in sentiment?
While these companies are still posting impressive profits, there's a sense that the market is looking beyond the immediate numbers and focusing on potential headwinds. Concerns about slowing economic growth, rising interest rates, and the possibility of increased regulation are all weighing on investor confidence.
So even though these companies are performing well on paper, the market seems to be saying, hold on, we're not so sure about the future.
Precisely. It's almost as if investors are having a bit of a reality check, realizing that even tech giants aren't immune to economic cycles and shifting market dynamics, and the emergence of new competitors, like DeepSeek, a Chinese AI startup that's making waves, is adding to the uncertainty. DeepSeek's rapid rise challenges the assumption of American dominance in AI and raises questions about the huge investments U.S. tech companies have been making in this area.
So it's a combination of internal and external pressures that's causing this reassessment of big tech. And let's not forget the wild card of President Trump's trade policies, which are adding another layer of complexity to the equation. It's hard to predict how his stance on tariffs, particularly those targeting China, will ultimately impact the tech sector.
Indeed. And this uncertainty is fueling volatility in the markets. With big swings in stock prices that can be unsettling for investors, it's definitely a time for caution and careful consideration.
Speaking of uncertainty and volatility, let's dive into the world of cryptocurrency, which is never short on either. MarketWatch reports a surge in crypto prices following President Trump's announcement about a strategic crypto reserve.
This announcement has definitely thrown a wrench into the gears, creating a lot of buzz and speculation. The problem is, the details are still very murky. We don't know the size of the reserve, how it will be funded, or when it will actually be created. It's a classic case of buy the rumor, sell the news. The market reacted strongly to the initial announcement, but now the focus is shifting to the details, or lack thereof.
Exactly. All we know for sure is that the reserve will feature Bitcoin, Ethereum, Solana, XRP, and Cardano. But what does this actually mean for the future of these cryptocurrencies? The White House Crypto Summit scheduled for this Friday might shed some light on the situation, but until then is anyone's guess.
And while the prospect of a government-backed crypto reserve is creating a lot of excitement, it's important to remember that the crypto market is still largely unregulated and prone to manipulation. This is especially true in the world of meme coins, which are often driven by hype and social media buzz rather than any fundamental value.
The Argentina crypto scandal involving President Milei and a meme coin called Libra is a perfect example of this.
Yeah.
The Wall Street Journal has a fascinating article that delves into the details of this saga. Basically, Milei endorsed this Libra coin, causing its price to skyrocket before crashing spectacularly. Many investors, who likely jumped in based on the president's endorsement, were left with significant losses.
It's a cautionary tale that highlights the risks involved in chasing quick profits in the crypto market, and the fact that there's an ongoing fraud investigation into the launch of Libra adds another layer of intrigue and uncertainty to the whole story.
It definitely raises questions about the role of influencers, especially those in positions of power, in promoting these types of investments. And it underscores the need for caution and due diligence before investing in anything, especially in the volatile world of cryptocurrency.
Absolutely. Even as crypto becomes more mainstream, it's crucial to remember that it's still a relatively new and evolving asset class. Investors need to be aware of the risks and proceed with caution.
Now let's shift our focus back to the U.S. consumer and the overall economic picture. MarketWatch paints a rather worrisome picture, suggesting that consumers are becoming increasingly anxious about their jobs and the future.
There's definitely a growing sense of unease among American households. Rising inflation is eating into their budgets. Government layoffs are creating uncertainty, and the potential impact of tariffs on prices and jobs is a major concern. All of this is weighing heavily on consumer confidence.
And consumer confidence is a key driver of economic growth. MarketWatch reports that consumer confidence has dipped significantly, and retail sales disappointed in January. This raises the question of what happens if this trend continues. Could a slowdown in consumer spending trigger a broader economic slowdown?
That's the million-dollar question. If consumers pull back on spending, it could have a ripple effect throughout the economy, leading to slower growth, reduced corporate profits, and potentially even job losses. It's a scenario that policymakers and economists are watching very closely.
And yet, amidst all this uncertainty and anxiety, there's a curious paradox at play. Credit spreads in the bond market remain relatively low, which seems to contradict the rising economic worries we've been discussing. What's your take on this disconnect?
It's a fascinating observation. It's almost as if the bond market isn't fully buying into the doom and gloom narrative just yet. Perhaps bond investors are seeing something that the rest of the market is missing. Or maybe they're simply more optimistic about the long-term prospects of the U.S. economy.
It's definitely a puzzle worth pondering. So we've covered a lot of ground in this first part of our deep dive. We've explored a split housing market, a massive EV fundraising, big tech facing headwinds, the unpredictable cryptocurrency market, and rising consumer anxieties.
It's a lot to digest, but it highlights the interconnectedness of the global financial system and the importance of staying informed and adapting to changing circumstances.
We've given our listeners a lot to think about. Let's take a quick break, and when we come back in part two, we'll delve deeper into some of these topics and explore potential strategies for navigating the challenges and opportunities that lie ahead.
You know, it's interesting to think about big tech in the context of these broader economic trends. Despite the market jitters, these companies are still generating massive profits.
That's true. Their fourth quarter earnings actually exceeded expectations. But as we discussed, the market seems to be looking beyond the current numbers.
Exactly. Bloomberg's analysis pointed out that investors are increasingly concerned about slowing growth, rising interest rates, and the impact of tariffs on global trade. And there's also the looming question of potential regulatory changes.
Regulation is a key factor, especially with a new administration in place. Their approach to big tech could have a huge impact on these companies' future prospects. It's a big unknown right now.
And that unknown is driving a lot of the volatility we're seeing. Those big swings in stock prices can be unsettling, especially for investors who are used to seeing tech stocks as a relatively safe haven.
Speaking of volatility, let's circle back to the cryptocurrency market. President Trump's announcement about a strategic crypto reserve certainly sent shockwaves through the crypto world, as MarketWatch reported.
It was a brilliant example of buy the rumor, sell the news. The initial announcement sent prices soaring,
Yeah.
but now the devil is in the details, and those details are still incredibly murky.
We're all waiting with bated breath for the White House Crypto Summit this Friday. Maybe then we'll get some clarity on the size of the reserve, how it will be funded, and what the timeline for implementation looks like. Until then, speculation will continue to be the main driver.
And that speculation is further amplified in the world of meme coins, which are often driven by hype and social media trends rather than any underlying value. The Argentina crypto scandal with President Milei and Libra, as covered by the Wall Street Journal, is a prime example of how quickly things can go wrong.
That story is wild. It just goes to show that even with crypto becoming more mainstream, there are still massive risks, especially with meme coins. It seems like a classic pump and dump scheme, leaving a lot of investors wondering if there was any legitimacy to it in the first place.
The ongoing fraud investigation will hopefully shed some light on the situation, but it certainly raises red flags about the potential for manipulation and the need for greater investor education in the crypto space.
It's a reminder that you should never invest more than you can afford to lose, especially in such a volatile market. Now let's bring this back to Main Street and consider how these global economic trends are impacting the average American consumer.
The MarketWatch article on consumer confidence paints a concerning picture. Rising inflation, government layoffs, and the potential impact of tariffs are creating a lot of anxiety for households. It's understandable that people are feeling uncertain about the future.
And this uncertainty could have a real impact on the economy. If consumers become too worried about their jobs and finances, they might start to pull back on spending, which could slow down economic growth.
That's the key concern. Consumer spending is a major driver of the U.S. economy.
Right.
If it weakens significantly, it could trigger a ripple effect, leading to decreased corporate profits, further job losses, and potentially even a recession.
It's a classic vicious cycle. But amidst all this economic uncertainty, there's one thing that doesn't quite add up. Credit spreads in the bond market remain relatively low. Shouldn't they be wider if investors are truly concerned about a potential recession?
It's an interesting paradox. Some analysts suggest that bond investors might be more optimistic about the long-term prospects of the economy than the stock market seems to be. Others argue that the bond market might simply be lagging behind, and we could see credit spreads widen if economic data continues to deteriorate.
It's definitely something to watch closely. So far, we've explored a split housing market, a bold move by BYD in the EV space, the tech sector's reality check, the roller coaster of the cryptocurrency market, and the growing anxieties of the American consumer.
These are all complex and interconnected issues, and it's crucial to understand how they might impact your own financial decisions.
In the final part of our deep dive, we'll shift gears and discuss some actionable strategies for navigating these uncertain times. We'll explore ways to protect your investments, manage your debt, and make smart financial decisions. In a potentially turbulent economic environment, we've covered a lot of ground today. From the anxieties surrounding the economy to the unpredictable nature of crypto, it's a lot to process. But knowledge is power.
Absolutely. Understanding the forces at play in the market is the first step toward making informed decisions.
So let's get practical. What can our listeners do to navigate these uncertain financial waters? What are some concrete steps they can take to protect themselves?
First and foremost, it's crucial to have a solid financial plan. Take a close look at your income, your expenses, your assets, and your debts. Understanding your overall financial picture is the foundation for making sound decisions.
That makes sense. You can't really make informed choices about your money if you don't have a clear picture of where you stand.
Exactly. Once you have a clear understanding of your financial position, you can start to identify areas of vulnerability and take steps to strengthen those areas.
For example, if you're worried about rising interest rates, like we discussed earlier, maybe focusing on paying down high-interest debt, like credit cards, would be a smart move.
That's an excellent strategy. Reducing your debt burden can free up cash flow and make you less susceptible to economic shocks.
And speaking of economic shocks, having an emergency fund is always a good idea, right?
Absolutely. Having a cushion of savings that you can tap into if you face unexpected job loss, medical bills, or other emergencies can provide immense peace of mind and financial stability.
I remember reading somewhere that the general rule of thumb is to have 3 to 6 months worth of living expenses saved up in an easily accessible account.
That's a good starting point, but it's always best to personalize it based on your individual circumstances and risk tolerance. And remember, building an emergency fund takes time. Start small and be consistent with your savings.
Consistency is key. Now let's talk about investments. Given the volatility we're seeing in the stock market, diversification seems more important than ever.
Diversification is absolutely crucial for managing risk. Don't put all your eggs in one basket, as the saying goes. Spread your investments across different asset classes, like stocks, bonds, real estate, and even consider alternative investments like cryptocurrencies, if that aligns with your risk appetite.
And within each asset class, you can diversify even further. For example, if you're investing in stocks, you might want to consider a mix of large cap, mid cap, and small cap companies across different sectors and geographies.
That's a great point. Diversifying across sectors can help protect you from downturns in specific industries, and diversifying geographically can reduce your exposure to risks in any one country or region.
It's like creating a safety net for your portfolio. And let's not forget about time diversification. Investing consistently over a long period, rather than trying to time the market, can smooth out those ups and downs and potentially lead to better long-term returns.
Exactly. Time in the market is often more important than timing the market. And remember, you don't have to navigate these complexities alone. Financial advisors can provide personalized guidance and help you create a plan that aligns with your specific goals and risk tolerance.
Especially during times of uncertainty, having a professional in your corner can be incredibly valuable. They can help you sift through all the noise and make informed decisions that are right for you.
So to recap, some key strategies for navigating economic uncertainty include developing a solid financial plan, paying down high-interest debt, building an emergency fund, diversifying your investments, and seeking professional advice when needed.
It's all about taking proactive steps to protect your financial well-being. And remember, it's a marathon, not a sprint.
Absolutely. Don't let fear or uncertainty paralyze you. Take action, stay informed, and focus on the long term.
That's great advice. We've covered a lot of ground in this deep dive, exploring the complexities of the current financial landscape.
From the split housing market and BYD's big EV play to the wild world of crypto and the anxieties of the American consumer, we've touched on many of the key themes shaping the markets right now.
I hope this deep dive has given our listeners a clearer understanding of these trends and some actionable strategies for navigating them.
I agree. Knowledge is power, and we aim to empower our listeners to make informed financial decisions.
And on that note, we'll wrap up this episode of the Pro Taker Podcast. We'll see you all tomorrow morning with new headlines from major financial magazines.